Hey everyone, Jeff Dorman here, Chief Investment Officer of Arca, back for another edition of Two Satoshis Live. Today I'm joined by my esteemed colleague, Connor King. How are you today, Connor?
I'm doing well, man. How are you?
I'm great. For those who don't know, Connor was a portfolio manager in digital assets, lives in Ohio, another big Cleveland sports fan like myself, go Browns,
Yes, sir.
and also works on the Arca business development team here. So doing a lot of different things for Arca and very knowledgeable about digital assets. So thanks for coming on today, Connor.
Thanks for having me, man. I'm excited to do this.
So here's what we're going to talk about. You and I got into not a heated debate, but certainly a debate
Yeah.
a couple weeks ago on whether or not the Fat Protocol thesis was actually real and whether or not it was playing out. So for those not familiar, the Fat Protocol thesis was written, I believe, in 2016 by a couple of folks over at Union Square Ventures. I believe Joel Monegro is credited as the author of it. But the Fat Protocol thesis basically says that unlike traditional Web 2, where the protocols themselves, whether that's HTTP protocol or SMTP protocol for email, the protocols themselves were captured none of the value, and it was all the applications built on top of the protocols, your Amazons, your Googles, your Apples, your Facebooks, et cetera, that accrued all the value. The theory of the Fat Protocol thesis was that because of the way blockchain works and because of the security layer of the tokens, that the tokens underlying the protocol itself will actually capture all the value and not the applications. So 5 years later, we're potentially seeing that, right? The value of all smart contract platforms, whereas once it was just Ethereum, now, obviously, we're seeing a lot of growth in other ecosystems, probably most notably Solana, but also, Avalanche and Terra Luna, and maybe one day Cardano and some others. But bottom line is they're starting to see real growth here of the tokens underlying these different smart contract platforms. So my question to you, Connor, is: do you think the Fat Protocol thesis has been proven, or do you think there's something else going on?
Right. That's a interesting point and concept, and it's something that we've talked about a little bit internally. Um, Me personally, I believe that it has played out, and I think the market has the consensus that it has played out. Because I mean, if you look at the top 10 assets, 70-80% of them are essentially layer ones. And even if you look at the top 20 assets by market cap, more than half of those are also layer ones. So I think that the market really has come to the agreement that the Fat Protocol thesis really came to fruition and does hold true.
And these are not small valuations, right? Ethereum, which I think still does about 75% of all the transactions, if not more, and certainly dominates all of TVL. Ethereum is 550 billion, but now you have Solana at 75 billion, Cardano 70 billion, Polkadot 50 billion, Luna 20 billion, Avalanche 20 billion, Algorand 12 billion. You can even go on to like Cosmos at 8 billion, and Phantom at 7 billion. This doesn't even include, the 2017 legacy protocols like Tezos and EOS, which largely haven't done anything, but are still at 5 billion valuation. So, yeah, these are not small numbers, right? These are huge market caps now for some of these projects. So you're in a belief then that this is based on value. You think the market is saying we think that the growth of these ecosystems do in fact accrue value to the tokens. Let me throw a couple things at you that would potentially be the other side of this. So one is very few of these smart contract protocols can actually be valued using any traditional metrics, right? If you're looking at cash flow analysis, you could make an argument that the only ones that you could actually value in that way right now would be Ethereum because of EIP 1559 and because of the potentially deflationary nature of the token, and Terra Luna, just because the entire blockchain was built around the idea of as the UST stablecoin grows, that ultimately there's going to be fees that accrue and burn the Luna token. But outside of those, there's certainly not enough economic activity happening yet to generate fees. So, are you suggesting then that the market is anticipating that there's going to be higher fees and higher economic activity in the future, and that you will be able to value it that way, or is this more of a Moore's law that just the overall growth of these ecosystems is so large that trying to value it using traditional metrics just makes no sense?
Right. I think it's honestly a combination of both. Like with the layer ones, I think they have pretty much like the largest TAMs in anything in crypto because everything's going to be built on top of that. Whereas like maybe like a DEX can only do so much, whereas like the layer one is holding and controlling like all that value. Something that's interesting that the Bankless guys wrote about a while ago is like the idea of like a triple point asset. And with these layer ones, they're essentially working to be like ultrasound money. So there's three basic like aspects that come with this. And one is that the token has to be one, a capital asset, two, a commodity, and three, a store of value. So essentially each respective layer one is competing to capture like all three of those points of that like ultrasound money flywheel.
Yeah, one of the things we have another colleague over here at Arca, Nick Host, who joined us on Two Satoshis Live a few weeks ago, but he came up with an analogy that I like to use now around. Imagine if you could, fund a brand new island. So you go in the middle of the Pacific. There's an island there. Nobody's touched it, and you could fund it, right? That would effectively be your protocol or your land value. That by itself has very little value, right? It only has speculative value of what people think could be built upon it. But if in 5 to 10 years you actually build a real economy on that island, you start to build schools and roads and restaurants and businesses. Well, all of a sudden, then you have real economic activity there. You start to have rents, you start to have taxes, you start to have fees and things that accrue back to the land itself. In some ways, that's what the market is telling you on these protocols: is that whether that economic activity is here today or not, they think that this is basically a blank canvas or a blank country, and ultimately real economic activity is going to happen on there and accrue back to the tokens. I thought that was pretty interesting. I thought that was an interesting way of looking at this, where, again, maybe you can't value it today, but you could certainly look at, if you had 10 islands, let's say, and one was smaller than another, the bigger one might have more value. So that could, warrant why Solana has such a big market cap relative to others, that people think just the speed and the throughput of what Solana can do is so much bigger than, say, what maybe what a Luna could do or what an Avalanche could do, that it warrants the higher valuation, even though the economic activity is largely similar to non-existent. What are your thoughts on that?
No, I agree. I think that makes sense. Yeah, I mean, because essentially like markets are forward looking, and there's always a saying like skate to where the puck's going. And something that's interesting right now is like the debate between Ethereum and Solana. And I'm a big proponent of Solana personally. I think the high throughput and the cost of the transactions are vital, and how fast the chain moves. And that's really important for the marginal crypto user. I was actually at the barber shop last week, and I thought that was pretty funny. He follows crypto loosely, like he knows what Bitcoin and Ethereum is, but not a ton about everything else. But he's trying to like really become more active in this space and learn more. And he came across like a YouTube video on how to trade on like a DEX, and he watched it and tried to do it. And then he saw like the gas fees for Ethereum were super high. So he tried to figure out how can I reduce like gas fees, and then he was brought to like these bridgings and L2s, but he just became too frustrated with the steps that he needed to take. So I think that really points to like a value prop for something like Solana, given how fast and how cheap it is. Like you load some Sol in like your Phantom wallet, and then you go interact with the DEX and the Solana based blockchain. You can do all of that in like 15 seconds for a fraction of a penny. And I think that honestly creates a very smooth flow for the marginal crypto user, because they're not going to have the amount of like just dollars to pay for high gas fees. And hopefully like layer twos help fix this with Ethereum, bullish Ethereum as well. But I think right now for the marginal crypto user, they want that seamless and fast experience, and that's what they're used to when they go on like their MacBook. Their MacBook's fast, their iPhone's fast, their gaming console's fast, their internet's fast. They're used to like fast things, and we live in such an ADHD society now that they really optimize for that.
Yeah, I agree with that, but I think I'll play devil's advocate here for a second. So we actually ran another Arca colleague of ours, Sasha Fleischman, ran some analysis. When Ethereum got to a $25 billion market cap and about 10 billion of TVL, that was basically summer of 2020. And that's right around where a lot of these other chains are right now, right? I mean, we just mentioned Solana and Cardano and a couple others are bigger than $25 billion market caps right now. But at least from a TVL standpoint, they're all right in that kind of 10 to $15 billion TVL range, which is right where Ethereum was basically a year and a half ago. So if you were to look at the prices of just using DeFi as a proxy, let's say that all of DeFi was the first actual application to work on Ethereum. So if you look at the first application that was working, and you started investing right around summer of 2020, you actually would have made about 7 times as much money had you invested in DeFi rather than in ETH itself. So basically what I'm getting at is, at some point, the expectations or the future value of a protocol has to be replaced by actual value that's happening, right? So, again, right when DeFi started to take off, had you invested there, you would have made about 7x. So by that same logic, with Solana at 75 billion market cap and 15 billion TVL, and something like Terra Luna at a $20 billion market cap and 11 billion TVL, at some point the applications have to take off. You can't just be this futuristic society forever with no working applications. Eventually the roads have to get built, the schools have to get built, the business have to get built. So what I would look at as an investor, I would say, okay, this has been a great run. I'm happy that all these layer one blockchains have done as well as they have, but they can't continue to do well unless we eventually have real working apps. So for your barbershop example, that's great that he's looking to lower fees, but where is he going to go use those lower fees, right? What applications are being built on these other blockchains that work today that you can actually use them? And whether or not, we're a month away or 6 months away or 12 months away, eventually that value has to be replaced. And I think another way to look at this is, again, our colleague Nick, who wrote the same thing, said, if you look at if you go back to that same kind of country example, in the US, the money supply is $20 trillion, but the total value of all US equities is about $50 trillion. So the application layer in this case, or the companies in the US equity market, is basically 2.5 to 1 as large as the underlying currency. So by that same logic, that's what you would expect for things like Ethereum. If Ethereum is $550 billion, there should be $1 trillion worth of applications that are built upon Ethereum. If Solana is 75 billion, there should be $150 billion or more of economic activity or tokens that live on top of the Solana ecosystem. So I think we'll probably get there. But to me, what that tells me is that it's time to start rotating out of the layer ones into the applications. And if those applications don't exist yet, it might just mean that these layer one blockchains are a little too far ahead of itself.
Yeah, no, I totally agree. And honestly, you and I both know this. The space moves a lot on like narratives. So like last year, DeFi was probably the biggest narrative of the year. And we've really been talking about like multi-chain for a while now. Like it was talked about back in like 2017, 2018 with like Cosmos and Polkadot. But now like the multi-chain world is actually here, and we can actually like interact within different ecosystems and layer ones. And I think that's what the market is really excited about, is now that we're able to like interact with alternative layer ones outside of Ethereum, and there's actually like use cases growing there. So I do agree with you that more applications will need to be built on these respective layer ones for them to like hold value and actually remain like active.
Yeah,
Because if not, then
Yeah, 100%. I agree. And I think the numbers are pretty telling, right? So Bitcoin, for example, Bitcoin started the year at a $550 billion market cap versus the totality of all layer ones at only 100 billion. So Bitcoin started almost, more than 5 to 1 larger than the entire layer one ecosystem. Fast forward to today, Bitcoin has basically doubled. It's now a little over $1 trillion asset, but layer one blockchains are up on average 8x. So the actual market cap gains of layer one blockchains exceeds the market cap gains of Bitcoin, starting on a much lower base. And I think the same thing is going to start happening on the application level, which is, okay, now that the layer one blockchains are as big as they are, you see these massive ecosystem funds that are being launched. Phantom came out with a $300 million ecosystem fund, Avalanche 180 million, Algorand 330 million, then Near Protocol 800 million. Look at these huge ecosystem funds that are being spun up by the layer one blockchains. That money has to go invest in the growth of these applications that are going to be built on their blockchains. And that might take 6, 12, 18 months. So the question for investors is like, what do you do in the near term? Do you continue to kind of have the lazy man index by owning the protocol itself, waiting for these applications to be built? Or do you go find those applications and invest in those and assume that, just like DeFi versus Ethereum or NFTs and gaming versus Ethereum, that these applications are going to start to run? I'm in the camp that, quite frankly, I don't know. I guess I would err on the side of the applications being a better investment here than the layer one protocol. But either way, I think going back to the question we asked at the top of the hour, does this validate the Fat Protocol thesis? To me, not yet. It doesn't mean it won't one day, but to me, the rise in the layer one protocols is based on speculation and sort of a lazy way of playing the entire growth of the ecosystem, not necessarily value accrual. And if you actually read the Fat Protocol thesis, the thesis is that the value accrues to the protocol. I'm not sure if we can conclude that yet, more so than just the interest from investors has accrued to the protocol, but not necessarily the value itself.
I agree.
But we will see. Regardless, regardless of the reason or what the long-term ramifications are, it was another strong week for digital assets. The overall market was on fire last week. You had pretty good macro economic indicators last week with the tapering starting from the Fed, but no rate increases. You had the 10-year is back below 150. The dollar is starting to move lower. Equities are higher. It's pretty hard to not be excited about what's happening in digital assets. So whether that's layer ones or whether that's gaming and metaverse or Web3 or DeFi, I would say all signs are pointing towards staying long and doing your research and finding good places to invest. So, given we only got a couple minutes here, Connor, anything else to shout out to the listeners here? Anything that you're looking at?
The Browns won. I gotta shout my Cleveland Browns out. I know Jeff and I are both longtime Browns fans, so wanted to shout that out. Aside from digital assets, but other than that, I mean, it's an exciting time to be in the space. A lot of capital flowing, a lot of interest accruing. Yeah, I mean, it's a great space to be involved in.
Yeah, the Browns are a good example of decentralization. You get rid of OBJ, and the Browns come together as a team. So, I think that's a good way to end it. Connor, thanks for joining us. Appreciate your
Awesome.
inputs here on Layer 1 Protocols, and everyone can find Connor on Twitter. You can find myself on Twitter. You can also go to our website ar.ca to read the blog that we wrote yesterday called "Revisiting the Fat Protocol Thesis." So that's it. That's our two Satoshis. Thanks, everybody.
Awesome. Thanks.